All right, everybody, welcome. We are live here for the YFP Fellowship. Today, we are going to talk about insurance. Does anyone have any questions related to insurance before I dive into the wonderful presentation we prepared for you? Austin, maybe.
How do you feel about extra life insurance as far as like term and all that kind of good stuff?
So we are going to talk about that here in a little bit. So I don't spoil my bias more than I'm already going to here in a minute. When you say extra insurance is what confuses me, because what classifies it as extra? Above and beyond what you need, I don't like that. Beyond what your employer offers, I do like that. So we'll definitely talk about that here in a little bit. That's a good lead in. Anybody else got a big question, overarching question? What about the gallery there, Allison? No.
The what?
Allison has
talking about my audience of
the audience
of my boyfriend and my dog.
Yeah.
Oh, we're good.
All right. Okay. So let me share my screen here. Can everyone see my screen? All right. Cool. So we are going to talk about insurance for the most part. Going forward, we have 3 meetings left after this. I know you feel like you've seen me a million times, but this is only number 9. So we have 2 meetings that I do not have categories for, and we have the final wrap-up conclusion meeting. So are there topics that anyone wants to specifically talk about? Otherwise, you're going to see a poll, and I think that anybody who shows up to the meeting should have some priority over what we're going to talk about next. So is there any kind of ideas that people are looking forward to talk about? If I can guarantee attendance, we can also do a Q&A for the TIMs, where we could bring in the TIM pharmacists and the TIM CFP, but I have to guarantee that we're going to have people there. So I know you guys get busy. I'm not holding it against anyone for not showing up. I just don't want to waste too much of their time. Anybody got a topic that they have on the head of their mind, or do you guys want some examples? What are we looking for?
Examples would be good.
Examples are always nice. Just speaking from today, conversations about combining finances with spouses of significant others are going to be valuable. The FIRE movement, financial independence, retire early. Basically, how far out into the future do I have to keep working? That could be a good one. Obviously, we are a young crowd, so probably not too many people wanting to talk about adding a member to the family in whatever method that takes. Nobody really needs to talk about education planning. Estate planning is not going to be super valid for the majority of you. We can talk about purchasing a car. We can talk about general financial, the world as it stands. We can do a deeper dive into investments if anybody wants to talk about that. I get nods and laughs and shakes and people hiding their faces, but does that strike anybody's fancy?
Investments. Let's make some money.
We'll never promise any kind of returns there, but we can definitely talk about some tools you can use if you want to dig deeper into the investments world. Or do you guys just want to see a poll? Hopefully this isn't a private message. Digger look into investments. Okay. I got 2 for investments, a deeper dive. Anybody else?
Combining finances would be good.
Combining finances.
I agree with that.
2 for combining finances. Okay. So
I agree with that too.
That's 3. Here's what I'll do. I'll put a poll up on Mighty Networks. So Kim, make a note after this meeting. If I remember, I'll do it tonight. So if it happens tomorrow. So I'll put a poll up with those 2 at the top, and then we'll add one more and see what we want to do. We have 2 meetings left, so we can do both, unless we want to get a meeting of the TIMs. But cool. I'll ask this question again at the end of the meeting. So if anybody has any other ideas, we can talk about that. If anybody wants to do like real estate investing, salary negotiation, life planning, Cool. All right.
If we end up coming up with the 2 topics, the last meeting would be the one where we bring all the TIMs in. The 23rd would be the
if we
meeting.
do fill these with meetings, then yeah, I'll just get the TIMs in here. Yeah, I'm gonna make sure they get in here, but I don't want to force them into one of these if we don't have to. I want you to get more value if possible. So when we talk about insurance, all right, so the first thing we're going to talk about here, risk management, then we'll talk about life insurance, disability, professional liability, our philosophies, and then a little bit like recommendation style. So generally we'll ask these kind of questions. So these are some of the things to think about prior to going over insurance, right? So what financial concerns, this is always going to be the top question. So whenever we're talking about a topic, what other financial concerns are going to come into play? You've kind of already seen how a lot of these topics are going to be intertwined. So making one decision is going to impact another. So that's important. Have you updated your client portal, right? Everybody has access to Right Capital. If we're working together in the future, we want to make sure that's updated. Any recent life changes can be big. A lot of times having a recent life change is the reason that you get life insurance going or any other insurance policies. So we want to make sure those are accounted for. Any health concerns? If so, what are they? When you're applying for insurance across the board, unless it's a group policy, then we're going to have to worry about some kind of medical exam. So what health concerns we have right now, and is that relevant to the insurance policy we're applying for, and should we waiting to apply for that policy later? Recent benefits package. Also want to talk a little bit about renters, auto, homeowner insurance policies, any valuable property that we may want to insure, and then obviously always check your confidence at the door. I have enough confidence for all of us. So risk management. So risk management is the process that we go through when we're looking at big expenses. So these are some of the terms that insurance agencies are going to use that I want you to make sure you're aware of. So a risk is a condition where there's the possibility of two outcomes with one being undesirable. That undesirable outcome is referred to as a loss. A loss is generally caused by a peril. A peril is a cause of financial loss, like a flood or an illness. And then there are hazards. So a hazard is a condition that increases the probability of said loss. So a physical hazard would be physical characteristics that increase the chance of loss, like your location of your home nearest to the beach means you're more likely to get floods or to be hit by a hurricane if you're in Shreveport or Lake Jackson, right? Or Lake Charles. A moral hazard is a chance of loss from dishonesty. This is like someone intentionally causing loss or you overstating a loss, like flooding your kitchen when the hurricane came by so you can get new cabinets. Hurricanes are relevant right now. So, and then a morale hazard is an indifference to loss due to insurance. Generally creates a carelessness. So where I grew up in the South, you didn't really lock your doors. So I regularly forget to lock our front door here until my wife yells at me. So I have a morale hazard because my house is more likely to be robbed because I forget to lock my door. Does that make sense? All right. Now let's talk about managing your risk. Does anybody have a cat? Nobody has a cat? Cool, perfect. We'll talk about cats then. So let's say your cat's gonna scratch somebody, and that's the risk that we're worried about, unless Austin's calling a cat over. So let's say we're worried about a cat scratching somebody. So we could do some things with that risk. We could avoid it, retain it, share it, reduce it, or transfer it, okay? So we could avoid that risk by basically not having a cat or not exposing it to people, right? We could retain that risk, which is what everyone with a cat does. You just have a cat, and if your cat scratches somebody, you apologize and maybe give them a Band-Aid or call them a wuss. You could share that risk if there's other owners of the cat, then everybody's responsible for it. You could reduce the risk by maybe declawing the front legs of a cat or teaching your cat not to scratch people. That would be also good. Or you could transfer that risk, which is where you pass off that risk to somebody else, okay? And that's generally what we call insurance. Insurance is a form of risk transfer. Does that make sense? All right. So what is insurance? In general, insurance helps provide coverage against a catastrophic event, okay? So we don't have insurance for small, insignificant things. We only have insurance for catastrophic events. So they generally protect us from bankruptcy or provide for our independence or provide income. They can sometimes be used to accumulate wealth, but in very small instances. So we have flood insurance in case our house floods, but we don't have like rain insurance just in case our house gets wet. So that's the difference there. There are varying types of insurance and there are different coverage amounts, and we're going to talk a little about these. So there's life insurance, which is really death insurance, but life insurance sells better, so that's what they call it. There's disability insurance, which is if you have a disability. There's health insurance, homeowners, renters, autos, personal and professional liability. We'll talk about all these. Any of these policies can be purchased individually on your own, or they can be purchased through a group, such as your employer or professional organization. Any questions so far? Okay. Life insurance. Okay. 41% of Americans do not carry any life insurance at all. That is probably a number of you here today. Of those who do, nearly a third only have the basic group policies that they get through work. That's most of the rest of you. 93% overestimate the cost of life insurance. So basically they say, I can't get life insurance because it's too expensive. Not everyone needs life insurance, but if you do, we want to make sure we have the proper coverage. Does that make sense? All right. So an overview, again, insurance is only there to protect you from a catastrophic loss. So life insurance protects you from a catastrophic loss, but it doesn't necessarily protect you because you're dead. So it protects other people, whoever's dependent upon you, right? So it should provide income for your dependents, or it could leave a legacy. Like if I die, I want all my money to go to the Foundation for Homeless Dolphins because dolphins need more homes, and that's what you want to take care of, right? Let's talk some important aspects here. So we'll talk about the parties involved. So there are 4 main parties involved in an insurance contract, okay? There's the insured, that's the person we're protecting against dying. There's the insurer, that's the company. There's the beneficiary, the person that receives the benefit in the instance of death. And there's the owner, and that's the person that pays the policy premiums. Does that make sense? Okay, so you could be a couple of these things. You should not be all of them. Brittany, you could own a policy on yourself where your mom is the beneficiary and Allstate is the insurer. Carol, you could own a policy on your mom where your brother is the beneficiary and Allstate's the insurer. Austin, you could be the beneficiary in a policy, but you don't own it on somebody else, right? So there's a mixture there. You generally don't want to be the beneficiary of your own life insurance policy because again, you died, so you're not there. And you only want to have insurance on people that you have an insurable benefit for. So what I mean by that is if you have an insurable right to them, that means you are tied to them in some financial way. So Allison cannot get a policy on Austin because she probably, I don't know that you guys know each other. She probably doesn't know him. So if Austin dies, she shouldn't get any money. The example I like to use is I can't get a policy on Hulk Hogan. I'm pretty sure Hulk Hogan's going to die pretty soon. I would love to get an insurance policy against it, but I have no insurable right to it. But Hulk Hogan's ex-wife did have an insurable right to him. And even though they're divorced now, she can maintain that policy in perpetuity. So 20, 30 years after their divorce, she can still benefit from his death. Does that make sense? All right. So we can have either individual or group policies. Individual meaning you buy it directly from the insurer. Group meaning you buy it through a group like an employer or a professional organization. We'll talk about policy length, which is generally how long the policy lasts. And we'll talk about the death benefit, which is how much of a benefit it provides. All right. Now, the 2 main types of life insurance as we hear about are term life and whole life. So Austin, this kind of goes back to what you were talking about earlier, what you were asking about earlier. So term life is pure protection, okay? It pays if someone dies within a term. It can be 5-year, 10-year, 20-year, 30-year, term 80, lasts until you turn 80. So if you die within that period and you made all your premium payments, then it pays a benefit. If you die outside of that term, then they don't pay benefits. Does that make sense? All right. The premiums are generally flat the whole time in the policy. The death benefit is also flat. They're very inexpensive depending on your age when you get it and your health, but there's no cash value. So if you have a 30-year policy and you're 20 years in and you decide you want to cancel it, they don't give you any of the money back. Basically, you just turn off the benefit. All right. These are great for people who have a temporary need for life insurance. It provides a high benefit for a low cost. Whole life, on the other hand, is a little different. So it has a protection and a savings component. So they generally protect for your whole life. In the finance world, we're not very creative people, we're math people. So we generally just call things what they are. So term life lasts for a term, whole life lasts for your whole life. They provide lifelong protection. They're usually fixed, meaning the payment you pay is normally fixed. The benefit can be fixed and increase with investments. They're very expensive, right? So in all insurance policies, the likelihood of an event occurring adjusts how much it costs. So if something is more likely to happen, then they cost more to pay out, right? So since most everybody dies within their whole life, then it's more expensive. I think there's a couple people that have made it through life without dying, but not many. So questions so far? Does anybody have a term or whole life policy? Okay, is anybody gonna get offended when I shit on one of them here in a minute? Perfect. Okay, cool. So term versus whole life. It is difficult to get a man to understand something when his salary depends on his not understanding it. Okay. So it's hard to get somebody to understand something when their money is tied to them not understanding it. Right. So let's talk about this for a minute. So term life and whole life both have limitations. So term life, if you don't get it when you're young, gets exponentially more expensive because the older you get, the more likely you are to die. So that's how that works. If your policy ends and you want to get a new policy, you're going to be much older in the future, so it's more expensive. Most term policies lapse without ever collecting a death benefit, which sounds like a waste of money, but also you didn't die. So there's that. But there is no cash value. So again, if you want to cancel 20 years into a 30-year term policy, you don't get any of your money back. All right. Whole life has a lot more limitations. So whole life is very expensive. And when I say very expensive, I will show you on this next slide how very expensive it is. And the reason for that is because the person selling you the whole life policy makes a commission, a large commission. In the first year, they're going to make between 30 and 90% of your premium. And then every year after that, they're going to make between 3 and 10% of your premium payments. So they get paid forever. It's called trails or trailing commissions or renewals. So very expensive policies for the same death benefit. They're generally unnecessary, right? So whole life policies last your whole life. Well, when you're 90, you probably don't need life insurance anymore because you've probably paid off all your debts. You're not working anymore, so no one's dependent on your income. All your children and grandchildren are self-dependent by this point. So the only thing that may require you to have an insurance policy is to pay for your final expenses, which you could save for on your own. And if you wanted to leave a legacy to those homeless dolphins we talked about earlier. So probably unnecessary. Although they have investment options, there's generally better investment options, right? I'd rather put money towards an emergency fund. I'd rather pay down some debt. I'd rather put towards my retirement. I'd rather put in a 529 college savings fund. Some of them have guaranteed returns. You'll see that a lot. That's a really big sales pitch. But those returns are generally lower than you could get on the outside of these policies. Life changes, right? Your life is going to change. Your family size is going to increase or decrease in the future. And you're going to need more or less insurance. So buying an entire lifelong policy is probably not your best bet when generally your insurance need is only temporary. And these policies are very complex. So anybody here who works in a hospital setting is definitely going to hear for some whole life policy salespeople. And anybody who works in the retail side, you're probably still going to hear a lot of people from this. So you will hear the pitch that, oh, do you need to save for your kids' college? Do that in this indexed and universal whole life policy. Oh, you need to save for retirement? Do it in this policy. Oh, you need to save for a house in the future? Do it with your insurance policy. You can put this extra money in, it'll go into a cash value. You can invest in index funds on the side, it'll grow. And it starts sounding really great, but it's not. So I generally compare whole life policies to the instant pot. I'm sure at least one of you has an Instant Pot and you probably love it. I fucking hate the Instant Pot because it's not as good as other things. Okay. So an Instant Pot can rice maker, pressure cooker, crock pot, bread maker, yogurt maker. Okay. But it doesn't cook rice as good as my rice maker. It doesn't crock pot as good as my crock pot. I don't need a pressure cooker. I've never made bread in my life. And who the fuck makes yogurt? You just buy yogurt. Okay. So a whole life policy will do a whole bunch of these things, but it will do none of them as good as their individual counterparts. Okay. So it's that jack of all trades, master of none. I'd rather get a bunch of masters than have a jack of all trades. Does that make sense? Brittany, rock on with your Instant Pot. If you have decreased cabinet space or anything like that, then Instant Pot's great. But when it comes to insurance and investment products, they don't take up space. So we can specialize. So when I'm talking about the price being different, okay, so if we take a 30-year-old woman with a $500,000 policy, that's going to cost like $30 a month for a 30-year term policy, or $4,000 a year for a whole life policy, okay? And this is what you pay every year the policy's in effect, okay? So we're talking $335 a year for 30 years, or I could pay $4,000 a year for the rest of time. So when I say like, oh, there's better uses for the money, I can get the exact same coverage for that 30-year time frame, and I could just save the other $3,800 in an investment account and build the difference up. So by the time I end this 30 years, I have enough money on the side to do anything I wanted. Does that make sense? So if we're ever looking for extra policies, we're generally going to look on the term side because I have a temporary need and the cost benefit analysis is just not there for whole life policies. Now, whole life policies exist for a reason. There are people that should have a whole life policy, okay? It's probably only about 3% of the population if I was making up numbers though, because maybe you have a legacy need that you want to keep. So you want to always have $1 million going to somebody in the future. Maybe you know that you're going to have medical issues in the future that you're not going to qualify for insurance products. Maybe you got a really cheap policy when you were a kid and it just lasts forever. Who knows? But generally, for the majority of everyone here, term life is where you're going to want to look. Okay. Any questions about that?
How do you know which of these like price coverage amounts makes the most sense? I mean, obviously you base it off of maybe like your income and what your dependents might need and like the amount of debt that you have. But do you have a good rule of thumb for us to be thinking about beyond those like hardcore numbers?
Allison, I'm really glad you work with us. So when we're talking about life insurance calculations and how much we should have, here's what we have. And there's a rule of thumb on there for you, but that rule of thumb is total garbage. So, all right. So there's two calculations that we generally want to use for life insurance calculations. So we can use the financial needs calculator or the human life value calculator. Okay. So the financial needs calculator basically says, what are all the things that I want to happen if I die? Right? Okay, cool. Well, I want to pay all my final expenses. I want to pay off any debts that I have. I want to plus up an emergency fund for my significant other, spouse, parents, brother, sister, niece, nephew, cat, whoever needs it. I want to provide some income to the survivors. Maybe I want to allow so-and-so to take time off, right? So for some of you, it could be, hey, I just, my debt dies with me. My student loans are gone, so I don't really care about that. Those are gone. Well, I have some other debt I want to pay off. Maybe I bought a house and I want to pay off the house so my significant other or whoever's living with me doesn't have to have this. To speak from experience, when I was younger, when I was in the military, I had a $450,000 life insurance policy because that's what the military gave me. So I was like, well, what am I gonna do with this 450 grand after I'm dead? Well, cool. 200 grand goes to pay off my mom's house. 200 grand goes to pay off my sister's house. And then like 50 grand goes to like seed a college fund for my niece and nephew. Cool. I didn't have any debt. I didn't own anything really. Everything else was just gonna go in the trash. Here's some money for you guys. Have a better life. Okay, cool. So now I'm married. Life is different. So I have a $400,000 policy now. So what do I want that money to go to? Well, $200,000 will pay off the house that I'm sitting in, and $200,000 will pay off my wife's student loans. 400 grand gone right there. Do I need more coverage than that? Not really. My wife works. She could fund her own lifestyle if she had to without me. I don't want to leave her so much money that her next husband can buy a boat. So there's that. And it works out. If I had a spouse that did not work for any number of reasons, then maybe I want to leave some more money behind for them. Maybe I want to leave some money behind so she could take time off to mourn me. I just don't think that's going to happen. So she'll be all right. But does that make sense? So
how did you decide that you wanted to have a life insurance policy? Like, that's what I'm struggling with. I'm like, well, do I want that?
Yeah. So the big thing with there is a lot of times you'll get a policy from work, right? So your employer may offer you a policy that says, hey, every employee gets 1, maybe 2x their salary compensation and automatically as life insurance. And then there's voluntary insurance you can take above and beyond that. But realistically, it's really just up to you. We have a lot of clients that I say, you don't really need life insurance. You're young, you're single, you don't have any debt that's going to transfer to anyone else. Like, yeah, your car has a loan, but your car will just get repossessed. Like, no one needs your car. You don't own a home that you want to pass on to anybody. All your student loans die with you. Maybe leave some money for your parents to take your dog. Having money for final expenses is a thing, but if you had an emergency fund and you died, that's the only emergency you got left. So like that money can be transferred. So in reality, not everyone needs life insurance. This calculation kind of decides what things do I want to happen. And if those can happen without a life insurance policy, then you don't really need it. But you do have to look to the future. Okay. So life insurance will never be as cheap as it is when you are young and healthy. So as you get older and as you get less healthy, unhealthier, words are a thing. As you deteriorate as a human, insurance is going to be more expensive. So sometimes it can behoove you to purchase a larger policy before you need it. But that is a salesperson talking that says, oh, you're going to need this down the line. You should buy it today. If that's something that makes you feel better about yourself, then do that. Some people like to have that warm and fuzzy that they know that their whoever is going to be taken care of. If you feel that way already, then you're fine. And if not, then you can go with the policy. Does that make sense? All right, cool. So the other calculation is called the human life value. This is a darker calculation. This basically says, how old are you today? How long are you going to work? How much money are you going to make over your lifespan? And then what would it cost me to replace you right now? So how much money do I need to replace you financially? So let's say we're a family with 3 kids. If one earning member of the family passes away, that is a detriment to the entire family unit. So what would it cost to replace that person right then is a very valuable calculation. But that assumes that life is going to carry on as normal, which is not the case. When someone passes away, life is going to change one way or the other. Either it's going to get more expensive or you're going to decrease your expenses to live within your new income, right? So this calculation is really ugly to do. So the rule of thumb there is 10 to 12 times your salary. So that's the rule of thumb that you'll hear in the industry. It says, oh, you make 100 grand, you need $1 million of life insurance. That's a lot of life insurance, okay? Now, if we go back a slide, we can see like $1 million life insurance, if we do in 30-year term, isn't that much, but that's still $585 that could be going towards other things like paying down credit card debt, paying down student loans, doing this and that, right? And it's definitely better than the $8,000 we'll be paying for whole life, right? So definitely, it's an idea, right? Do you need $1 million life insurance? Maybe, maybe not. What do you want to happen? Go back to that financial needs calculator. If you want to leave a large sum of money for your church, for your favorite charitable organization, for your neighbor Ted down the street, for the Robert Lopez Needs a Jet Ski Fund, then you can go there. But this is really a personal question. I can run a calculation that says, if you want your significant other's life to carry on exactly the same, this is how much money it takes. But that's not going to be applicable for the majority of you. Does that make sense?
If you end up getting like a 20-year term or a 30-year term, and then you get to I don't know, 30 years now, let's 60 or 50, and you're like, oh, well, I'm still here. Can you just add on more terms and expand it that way?
Yeah. So that's a good question.
Is it going to be more expensive?
It's going to be way more expensive. But you may also, again, you may not need it at that point, right? So if we do the financial needs calculator, we say, hey, I want to pay off this, I want to pay off that, I want to pay off that. Well, 30 years from now, you may not have those anymore. You may have paid that house off already. Your kids could be out of college already. 30 years. The reason we recommend 30 years a lot of times is because it gets you through most of those life issues, right? 30 years from now, the majority of you are going to be almost retired, should you choose to. Some of you will already be retired because you chose to. Some of you are just making cutting boards your whole life now from now on. He's frozen. I don't think he can hear us. So it's really going to be personal to you. But yeah, if you wanted to re-up, you could get a new policy at that point, or you could, some policies actually have an extension built in, but that extension is very expensive. So it's not generally going to be your best bet. But yeah, if you're 60 and you still need life insurance, yeah.
Sorry, you cut out. So you said the extension was expensive? Like just after that? Okay.
Yeah, a lot of times the
Sorry.
extension that's built onto a policy already is going to be very expensive. But if you need insurance still, then yeah, we want to get another policy in place. Sometimes what we can do is we can stack policies, right? So maybe we want $1 million of coverage, but we really only need like $1 million for the first 20 years. And then maybe we only need 500 after that. So what we can do is we could do a $500,000 30-year term and a $500,000 20-year term. And that can help us kind of just cover that gap. Now, this math, it doesn't really make a whole lot of sense. I'd rather just pay the extra money and get the $1 million for the whole time, but everyone's math is going to be a little different. So when you run examples and quotes, then you'll be able to run the difference and say, you know what, maybe we'll do 500 of this and 500 of this. So for the full 30 years, I'll have 500. And then for the first 20, I'll have $1 million because I have two stacked on top of each other. Right. So that could be an option in later life too, because maybe you can just add a new policy on top of what you already have. Because, you know, if you have kids or you have a whole farm full of animals, then we want to make sure that everybody's taken care of. Any other questions about life insurance?
Do you know, as far as like eligibility, like for the term, does your health, like, so say you had AFib at 22, so you still carry that, does that last for your life? So
that's going to be dependent on the insurance provider themselves. So each insurance companies are extremely good at math, and they can figure out what are the odds of them making money in a deal. And they're always going to write a policy where they're going to come out ahead. They're better than Vegas. Every big building you see in town is owned by an insurance company because they have to find somewhere to put all their money. So they're all going to have their own policies on what is required, how deep they look in their medical exam history, and what kind of qualifies you, disqualifies you. And then each insurance policy, it's not a yes or no, do you qualify? There's going to be levels and say, oh, you're this level, oh, you're CA plus, da da da. Or you're just like bottom of the barrel, you have to pay extra. The other option is, that's if you go individual. The other option is you can go through an employer or through a organization, and your employer may offer you 1X for free, and then maybe you can get up to like 4, 5, or 6X as a voluntary add-on. And that's an option you can do. But those policies are only going to be valid while you work for the employer. So we generally want you to get a policy outside of the employer, because you're going to change employers over time. Does that make sense? Cool. Any other questions about life insurance? All right, let's talk about disability insurance. So 1 in 3 working Americans will become disabled for 90 days or more before age 65. Now that's thinking 1 in 3 will become disabled for 90 days or more before age 65. That number sounds stupid high to me, but that's because 90% of those disabilities are caused by illness rather than accidents. Okay, so you're too sick to work. 62% of all personal bankruptcies filed in the US are attributed to medical problems. So basically, I get hurt or sick, I can't go to work, I lose my job, I can't pay my bills, now I'm bankrupt, right? So we want to avoid this at all costs. So I told you earlier, insurance policies are to protect you from a catastrophic loss. So who is dependent on your income? You are. You are dependent on your income, okay? So we want to protect that. you have a greater chance of financial hardship due to a disability or illness than you do of a premature death. So it's more likely that you'll have to use disability insurance than you will have to use a life insurance policy at a young age. So that means disability insurance is going to be more expensive. So when we get to that point, you'll see it's going to be more expensive. All right, some important aspects here. So individual or group. Again, you can buy this directly from the insurance company, or you can buy this through a employer or other organization. The definition of disability is very important. Well, how disabled is disabled is the question that they will be asking you, because insurance companies do not want to pay you out. So we have to have a definition in place. So am I so disabled that I can't do any job? Or am I so disabled I can't do my job? So the definitions there are any occupation or own occupation, okay? So any occupation is a little more vague. So that says I'm so disabled that I can't work in any job that I am experienced, educated, and qualified for, which is a lot of jobs for y'all. Or own occupation says I'm so disabled I cannot work in my own occupation, which is what we want. You worked really hard and you paid a bunch of money for someone to teach you how to do your job. I don't want you to get sick and then have to work somewhere else. So we want to make sure we have own occupation, but because own occupation is more specific, it costs more money. Does that make sense? All right. We'll talk about the elimination period. So the elimination period is how long you have to be sick or disabled, sick or disabled before they start paying you benefits. So that could be 7 days. Hey, you have to be unable to work for at least 7 days before we pay benefits, or it could be 180 days. You have to be unable to work for at least 180 days before we start paying benefits. The benefit amount is really important, right? So how much from a dollar figure or how much of a percentage of your salary are they going to pay? The benefit period, how long will they pay? So maybe they'll pay for 2 years, maybe they'll pay for 5 years, maybe they'll pay until age 65. Each one's going to be a little bit different. And then the tax treatment is very important here. If you pay the premiums, then the benefit is tax-free. If your employer pays the benefits, then the premiums, then the benefit is taxable income. Okay. Somebody has to pay the taxes and it's going to be you. So if you pay the premiums, that money is already taxed. So the benefit is free. If your employer pays the premiums, they're not going to pay taxes for you. So the benefit is going to be taxable income. Does that make sense? Okay. There are two different types generally. There's short-term disability and long-term disability. Again, we are not creative people. Short-term protects you from the short-term. Long-term protects you in the long-term. Those terms are relative. It basically means less than 2 years or more than 2 years, but in reality, it's closer to less than 6 months and more than 6 months. Okay. So a short-term disability will generally cover you for the first 6 months, and you're almost always going to get those from your employer. You can buy those outside of the employer, but they're going to be very expensive. So we generally don't buy those outside of the employer. Long-term disability covers you from generally 6 months on, or whenever your short-term disability ends on. And again, those can last 2 years, 5 years, until age 65. And they should say that in the policy. Does that make sense? Supplemental long-term disability would be a benefit that you get above and beyond anything you already have through your employer. So that would be in supplement to the policy you already have through your employer. That could be because you want to plus up if they have a shitty policy. It could be because one's going to be taxed and one is not, and you want to plus that up. It could just be because you want a higher benefit. So how much do we want? Infinity. I want all the money. If I'm disabled, I want all the money. But in reality, insurance companies are going to max you out. So we want to get at least 60%. The maximum you'll ever see is about 70%. On occasion, if somebody works at a hospital, you may see a short-term policy at like 80%, but that's not really common. So 66 and 2/6 or 2/3 is kind of the most you're going to see. So we want to shoot for 60%. If anybody works at like CVS, their long-term disability policy is like 40%, and then you can plus it up to 50 or 60 if you want to pay extra. Most employers are going to have a base benefit of 60%. Does that make sense? All right, and the supplemental policy can be used to plus that up, or you can supplement it with a more robust emergency fund. So if I don't have short-term disability through work, then maybe I just want to make sure that I have a strong emergency fund if something were to happen. If I get sick and unable to work for like 3 months, I want to have an emergency fund in place to protect me. Now, we talked about emergency funds. We already want to have like 3 to 6 months of expenses anyway. So we already kind of have that, but this may be more important if we don't have a supplemental short-term disability policy. Does that make sense? Cool. I said it was more expensive. So now we're talking, the example that we're going to look at here is for a male, non-smoking New Yorker with a degree and a $100,000 annual salary. They'll get a $5,000 a month benefit for a policy of own occupation, partial disability, move this out of the way, non-cancelable automatic increase benefit options. And this is going to cost roughly $1,400 to $1,500 a year for a 30-year-old. So earlier we're talking like $1 million policy for 30 years is like $600 a year. And now we're talking it's like $1,400 or $1,500 to get $5,000 a month. Okay. Disability insurance can be very expensive. So if we have access to one through your employer, we want to take advantage of it. If we have to buy on the outside, we just want to find the best policy for the best price. And a lot of times there are other groups out there that we can do it. We work really closely with APHA. APHA actually offers a group policy through their benefits, and it can be much cheaper. But other organizations also have policies, so you should look at those as well. Does that make sense? Any questions about disability insurance? Does anyone have disability insurance through work? Do you know what it is? Nope. Are you grabbing it? Is your open enrollment sheet behind you?
No, I am looking at like 4 screens at once. I have both short-term and long-term through my work. The company that it's specifically through, I don't remember. I could look it up, but
Yeah.
I do have it.
So good. So you're probably paying for it in some way. If it's offered to you as a benefit, you still kind of pay for it in your taxes. And then if and when you ever needed to receive those, you'd be paying taxes on that income. When you do your open enrollment period, which is either happening really shortly, for some of you, it's going to happen like next April if you were at CVS, then you just want to look at that and say, hey, am I enrolled in these benefits? A lot of times they're offered, but you're not enrolled in them. So if this is a policy you want to have in place, you should. Unlike life insurance, that there are definitely clients that don't need life insurance because no one else is dependent on their income. You are all dependent on your own income. Unless one of you has a high earning spouse or significant other that you're living with that can pay all the bills, then we want to have something in place. I, for instance, do not have a long-term disability policy. If I became disabled, my wife could afford to pay for us to live on. In such case, she does have a policy in place because I don't want to pay for her life if she's disabled. So that's how it works. So find out if you have a policy available to you. If not, find out if you need one and where you can go to get one. Again, you can go straight to the employers, to the insurance companies, or you can go through a group. I said APHA just because I know their policies, but other professional organizations will also have access. All right, some other riders that you should know about, some other features, right? Enhanced residual disability. What this means is, what if I'm kind of disabled? So what if I can work, but I can't work full-time anymore? I can only work part-time. This will cover you that difference in the benefit. So let's say I can work 50%. I used to make 100%. So I want to cover 60% of that difference. That's what enhanced residual disability would be. Non-cancelable and guaranteed renewable would mean that I can keep my benefit over time and you can't cancel on it. Let's say I get diagnosed with something and it's going to impact me later, but it is not currently impacting me now. I want to make sure that they can't cancel this policy on me now to protect themselves from the future. Okay, so that's what non-cancelable means. Benefit increase. Your salaries are probably going to rise, and we want to make sure that the benefit can grow with us. So that way we don't have to go and file a whole new policy in the future, go through a new medical exam and do that. We want our benefit to be able to grow with us over time. And then automatic increase is just like a cost of living adjustment. So this is like inflation on the policy itself. Does that make sense? Cool. professional liability insurance. Who has this? Who's heard of this? Okay, so people heard of it. Okay, cool. So professional liability insurance. So what's the purpose of this? So this protects us from a catastrophic loss, just like all other insurance policies. This is to protect us if you're ever individually named in a lawsuit. Okay. It can also protect you if your employer doesn't have proper coverage or chooses not to protect you. Or if you are working at a second job, you're volunteering, you give advice to a friend or neighbor, and they choose to sue you. Suing is the new American pastime. It's more popular than baseball, especially during COVID times, because nobody wants to watch baseball. So some of the key items here. So this is speaking directly to the Health Provider Service Organization, HPSO. This is what their policy terms, but generally all professional liability for pharmacist policies are going to be really similar. The only differences that you may see is if you do any kind of special compounding or if you have any special client relationships, in which case they may alter it for you specifically. But for the most part, it's going to provide a professional liability coverage, meaning it can protect you against liability up to about $1 million per claim or $3 million per year. A license protection up to $25,000 of annual aggregate. Personal liability coverage if someone wants to sue you outside of that for $1 million. It provides a defense attorney, not really for you, mostly to protect the insurance company, but you're also protected in the aspect there. Assault coverage, personal injury coverage, medical payments coverage, and also any kind of HIPAA problems. It can protect you up to $25,000 for that. So this is a really important policy to have if you do any kind of contact with patients or clients. So anytime someone can sue you, you want to have this. Some people are going to work in big pharma. They're not going to have any kind of liability for that. So not as big of an issue. But if you have any liability out there, meaning you're working directly with people that can sue you, it's important to have this. And it's very inexpensive. Okay. This is going to cost somewhere between like $50 and $150 a year. So you get all that protection for a very low expense. It's generally cheaper when you're younger and it gets more expensive as you kind of increase over time. If you know anybody, if you're working at a hospital that has ever been sued, this policy comes into play really fast and protects you really well. So if somebody starts suing a clinic or a hospital, they're going to try to sue everybody because somebody's not going to have the right protection. Someone's going to give them some money. So we want to try to get this protection. Does that make sense? All right. Other insurances to think. Yes.
I have a question. So with with the professional liability coverage, like I've seen conversations happen on the Facebook page about having your hospital sponsored coverage versus like going out and getting your own. What are your opinions on that?
If you can get a discounted policy in anything, then I want to look into that. One of the things that you always want to be protective against is getting a hospital sponsored policy. Is it a policy through the hospital or is it just the one that they like?
It's through them. I think that, for example, like I'm pretty sure my hospital gets me, I don't think I'm paying anything extra for my liability coverage, but I'm covered up to like $750 or $1 million or something, a large amount of money.
So we generally want to have an excess policy on the outside of that. One, because you're not always going to work for your hospital. Two, because if something happens outside of the hospital, their coverage may not travel with you. So let's say you are volunteering, or maybe you give advice to a neighbor, right? That's not that uncommon, right? If someone's over at your house for a barbecue and they start asking you questions, if you're the most experienced person at the table, you're going to talk about it. I do it with finances. I ask my doctor friends to look at my shoulder when they come over, right? It happens. So if someone ever wanted to sue you, you want to make sure you have a policy there to protect you. You've worked really hard. You've worked really hard to get where you are today, and you want to make sure we protect ourselves into the future. Good question. All right, some other insurances to think about here. So property and casualty. So property and casualty. So property would be like homeowners, renters, auto insurance. Casualty would be like protecting against liability insurance. Any kind of special endorsements would be things like jewelry or art, or if you have really expensive computer gaming system you want to protect against, you can get special endorsements or riders added onto your policies, okay? Let's talk about those for a minute. So generally in these policies, we're going to have the property coverage and the liability coverage, okay? So auto insurance. Generally, you're going to see things like 100, 300, meaning if you hit somebody, the insurance company will pay $100,000 per person you injure, up to $300,000 per incident or accident. Okay. That's really common coverage. But to think about that, if it's $100,000 per person, if there's only one person in the car, then the entire incident's only 100,000. So it's really like 100, 100. And since 90% of cars on the road only have one person in them, you really only have $100,000 coverage. Is that enough? Maybe. If you drive around a lot of expensive cars and people who are rich, maybe not. Right? You're also in there, you're going to have things like uninsured and underinsured, meaning if you hit somebody that does not have insurance, can you protect yourself? If you property damage, if you hit anything and you tear down a fence, you blow through a stop sign, slide into a curb, break your axle, slide into a fence, knock down a stop sign. Who's done that? But that could happen. So we want to make sure we have the right insurance policies in place. With homeowners insurance, we want to have dwelling coverage, meaning if a tree fell on my house, I want to get that fixed. If a storm comes through and damages something, I want to get that fixed. If someone slips and fall and hurts themselves in my house, I want to have liability protection from that, right? If my dog or my cat bites somebody, then I want to be protected against that. A lot of times that can be in a homeowner's or renter's policy, right? So we just want to make sure we have policies in place to protect us. Now, I can insure you against everything. So we don't want to do that. We want to have to retain some risks. But if something's likely to happen or is likely to be catastrophic, we definitely want to have a policy in place to protect it. Does anybody have any questions about homeowners, auto, or renters? All right. Has anyone ever heard of umbrella insurance? Oh, you have. Allison, what's umbrella insurance?
It's something that covers parts of everything.
Yeah. Umbrella insurance covers above and beyond everything, right? So just like an umbrella does. So let's say you have liability on your car, you have 100, 300, and you come out of the hospital and you hit a surgeon and he breaks his arm and they can't do surgery for a year. They're going to sue the shit out of you for all this, right? Your $100,000 is not going to be enough. Now they're coming for your money. Umbrella insurance would cover above and beyond that, and they're sold in $1 million increments. So you'd have $1 million of liability coverage. Generally, the only time you need umbrella insurance is if you have the net worth behind it to protect. Okay, I'll give you an example. I had a client in San Jose riding his motorcycle, got hit by a car, lost his leg. The lady who hit him had $7 million in net worth. So his lawyer's like, hey, we're going to sue this lady for like $7 million because that's everything she has. You lost your leg. You deserve a better one. So they go to sue this lady, but she has umbrella insurance for $5 million. So instead of going to court and fighting all the battles, the lawyer goes, hey, man, you just want to sue her for $5 million, settle out of court, be done tomorrow, get you a new leg next week? He's like, yeah, man, let's do that. So now we got $5 million, couple legs, way more legs than we have. The lady didn't lose any money because she had the umbrella insurance. Everybody walked away happy except for the insurance company. So umbrella insurance is there to protect your net worth from a big liability event. So to need umbrella insurance, we generally want to have that net worth to protect. Does that make sense? You can't just go out and buy umbrella insurance though, okay? Because umbrella insurance is going to cover above and beyond your auto, above and beyond your boat, above and beyond your home, they're going to want to make sure that all those underlying insurance policies don't suck. A lot of times they're actually going to make you have them all in one place. So like Nationwide is going to say you have to have all nationwide insurance policies and they all have to be to this level. And then we will sell you umbrella insurance policy. On occasion, you can get a third party umbrella policy, but they're probably more expensive. Which brings up, how expensive are they? Oh, this covers me for $1 million. This lady paid out $5 million for this dude to get some new legs. How does that work? Well, it's going to be really similar to the professional liability, and it's going to cost about $100 to $150 per $1 million of coverage. So it's a really cheap policy for the amount of benefit because it is unlikely to happen. Because they're unlikely to have to pay out a bunch of money, they don't charge you a lot. If it was likely to happen, they would charge you more. If you're looking for flood insurance and you live on the banks of a river that floods every year, that's really expensive insurance. If I look for hurricane insurance in Arizona, super cheap. Super cheap. Does that make sense? All right. Business liability insurance. Business liability insurance is important for anyone who is going to start a business, okay? So it protects the company and or the business owner in the event of a formal lawsuit or any other third-party claim. So coverage includes financial liability incurred in addition to expenses related to the legal defense. And there are three main types. There's general liability, professional liability, and product liability. So if anyone goes out and starts a business, please go speak to an insurance agent or a lawyer to tell you what kind of insurance that you need to have in place. Does that make sense? All right. So you've heard a lot about me talking. What's our general philosophy? Okay. So what are the do's and don'ts? We do think that everyone should purchase individual life and disability policies if they need them. Okay. We think you should keep it simple and just buy a term policies. So we don't need any complex whole life instant pots. We should purchase these policies as soon as we realize that we need them to lock them in, right? Now, Hayden, you could go out and you could buy a policy right now and it'd be super cheap relative to later, but if you don't need it, it's still an expense that you don't need, right? So once we realize we need a policy, that's when we want to get it. We don't want to wait and kick that can. We want to purchase supplemental disability policies if needed. So if our employer does not have enough policy or if our policy is too small through work, we want to make sure we're protected. And the way you realize that is basically, let's say you couldn't work right now. How are you going to live? What's going to happen? You're unable to work because of disability. What's going to happen? Okay, cool. I'll move back in with my parents and I'll do that. Okay, cool. Maybe you don't need an insurance policy for that. But if you don't have those options, you need to have something in place to protect you. And we always want to protect against professional liability. If we have professional liability, which means you are working with clients or you have the ability to work with clients, we want to have a policy in place to protect us for when they get happy and want to sue you. All right. What are some of the don'ts? I don't want you to discount this part of the financial plan. Okay. So a lot of times we talk about finances, people are like, oh, let's save, let's budget, let's invest, let's do all the fun stuff. Saving, budgeting, investing is fun, right? But insurance is just like, whatever. I'm worried about making money, not trying not to lose money. But when we're talking, I always want to protect and grow your assets, protect and grow your net worth. Protect is the first word there on purpose because I want to keep what I have whilst trying to get more. Okay. So we want to make sure we don't discount this part. We don't want to rely solely on our employer's insurance plans. Okay. Those are a perk, not a plan. As some of you saw when your employer took away the 401k matching this year, they could also take away these insurance policies because they're paying them for you. So those can go away. Also, when you leave your employer, the policy goes away too. It is only a term policy. It only lasts while you're with the employer. So if you leave, they're gone. So we want to make sure we have something outside of the employer because you may have a medical event that makes you uninsurable in the future. So we would like to have some sort of policy in place. We don't want to get hung up too much on what you actually need, right? Earlier, we did that financial needs calculator and I said, 400 grand, it'll cover this, this, and this. I could sit down with an Excel spreadsheet or a pen and paper and a calculator and figure out exactly the dollar figure I need to do everything I want. That's a lot of work and it's still going to be wrong because life's going to change tomorrow. So we don't get hung up on how much we need exactly. We just want to make sure we have enough to cover the big things. Life will figure itself out after that. And we don't want to listen to salespeople who say you need whole life. I thoroughly understand that I sound like a salesperson most of the time, except I'm selling you shit. Even if you were clients, you're just paying for our guidance and advice, right? I can't sell you any products, okay? If someone is incentivized to sell you something, you want to look a little deeper into what they're selling and make sure it's the best product, okay? A lot of insurance salespeople are not trying to sell you a bad product. They just are not aware that there are other products out there that may be better suited for you, okay? They are not held to a standard that says they have to sell you the best product. They have to sell you a suitable product. That is a technical term for a suitable product. It means one that is good enough. Okay. We don't want good enough. We want the best. I want what's best for me. All right. So they're going to sell you a suitable product. So be cautious of that. So if you do need a policy, where should you go? And before I show you this next slide, we do not get any kickbacks from me recommending places. I just recommend the places that we like. If you find a better place, cool, do that. But this is where I would send my sister if she needed insurance. I would send her to Policy Genius, okay? Policy Genius is a marketplace. It is not an insurance company. It's like sending someone to Orbitz or Expedia looking for flights rather than going directly to Delta or United. Unfortunately, Southwest Airlines not found on Expedia or Orbitz, so there are probably also insurance companies that are not found on Policy Genius. Oh well. All right, so there are hundreds of thousands of insurance agents in the US, okay? Average age being about 59, which means they are probably male, pale, and stale. So a bunch of old white dudes in that industry, okay? There are hundreds of different insurance companies that are all hundreds of years old, okay? Insurance is one of the oldest industries, and they're very good at math, so they stay around for a long time. They'll change their name and they'll change their logo, but they're still there, okay? So there are a bunch of options out there to choose from, and it's hard to know which one is the best. Every state's gonna have varying insurance regulations, so we wanna make sure we reach out to somebody who can do some of the looking for us, okay? So that's why we send people to Policy Genius, okay? It's got a website, it's clean and easy to use. You can run a quote tonight in like 5 minutes and get an idea of what an insurance policy would cost. The agents work on salaries rather than commissions. Okay, so they don't get paid extra if you're buying a bigger policy. They're just there to help you through a process. And because it's a marketplace, they can look at all the insurance companies and find you who's doing the best stuff right now. That's going to change, right? You may love an insurance company because so-and-so works there that you know, or because you have a policy with them in the past, but it still may not be the best one. If you do go out and get a policy, this is the process right here. Get advice. So either through an agent or through a knowledgeable professional. Go to a marketplace. There are other marketplaces, not just Policy Genius. There's Ladder Life. There's Low Load Insurance. There's DPL. There's a bunch. Find a marketplace that has a bunch of different policies. Pick one. Purchase it. Go through the process. They're going to have to do medical exams. They're going to have to do checks. They have to do paperwork. It's going to take weeks to get a policy in place. This is a very slow process. Once you get the policy, you have what's called the free look period, where the policy is technically in place, but you have not paid them yet. You've just agreed to pay them. In that time period, you can review the policy to make sure it's actually what you wanted, okay? Paul, our tax guy, once got a long-term disability policy that he thought was own occupation, but they wrote him a policy for any occupation. This is when he caught it. Paul has a very specific occupation. He doesn't want to do other things. He just wants to do what Paul does. So we want to make sure he has an own occupation. If it's caught, you can correct it. If you don't catch it, you're never going to look at that policy again. That policy is either going to get filed away in a drawer somewhere or saved in an electronic folder if you're better at saving trees. And that's what's going to happen. You're never going to look at it until you need it. So this is the time you actually want to review it in depth. Spend the minutes. It's not a user agreement at the end of a Microsoft page. Like you can actually read this one, okay? Questions about that? All right, so generally when we're talking about recommendations, it's good to try to map things out, okay? Basically say, hey, how much policy do I need? This is my income, this is how much I get through work, this is what I need, kind of map that all out. Come up with what you believe is the most important stuff, okay? If you need a $500,000 policy, cool, get a $500,000 policy. Just make sure you get it at a good price and make sure you stay in force when you make your premium payments. If you miss a premium payment, the policy could go away. It could just disappear. So you want to make sure you make your payments on time. If you need disability because you don't have it through work, go out, find some policies in the marketplace. If you need pet insurance, you can go to some of those other places, right? If you go to Policy Genius, they run it on health insurance, life insurance, car insurance, home insurance, pet. I say pet again because it's really weird that people buy pet insurance. But all right, we're gonna go back to the schedule real fast. So again, I'm gonna put a poll out and we're gonna talk about what we wanna have here. We're gonna talk about either investing or combining finances or fire. And then I'll put a poll up for some other choices. Cool. So everybody check Mighty Networks. You should see it come out. Questions about insurance? Questions about anything unrelated?
You did a good job making a fairly boring topic engaging. I just want to throw that out there.
Thank you. That was not a question, though. This doesn't say statements. This doesn't say ego boosts, but I'll still take them. Anybody got any questions financial related?
I have a question.
Yeah.
So back to the house thing. I think now everybody knows my business and then I'm looking at a house. So I'm doing all the pre-approval stuff right now. I made the mistake, obviously, looking at homes first. But looking at pre-approval stuff, there's options for co-borrowers. And again, the person that I'm applying with has a VA loan. Do you recommend that I make him my co-borrower? Will that put his VA loan at risk? How do we kind of approach that?
He currently has a VA loan in effect, like on a house.
No, so he could use it, but I'm thinking like if he
Oh.
becomes my co-borrower, will it
No.
kind of
So
utilize
a VA
or
loan is
waste his
just
VA
a
loan?
VA loan is just kind of type of loan. So it's kind of like you can get a conventional loan, you can get an FHA loan, you get a U.S. Department of Agriculture loan. A VA loan is just another type. If you don't use your VA loan, it doesn't impact your eligibility at all. So VA loan eligibility for those who care is if you have veteran status or active duty military member, then you have access to the VA loan, which gives you a lower down payment, gives you no private mortgage insurance. It gives you like lower like necessary credit scores to get a loan, and they will give you better rates as well a lot of times. But you only qualify for them if you have those benefits. If you use your eligibility, then it goes away. If you don't use your eligibility, then it doesn't matter. So adding him as a co-borrower would not affect his eligibility unless they used a VA loan. So if you went and got like a Farm D loan or just a conventional loan, it doesn't impact the VA at all. Now, if you buy a house with a co-borrower and then that person tries to go buy a house later, that house is still going to show up on their debt to income ratio. So that's a thing. But if you don't use your VA loan, then it doesn't impact anything. And even if you do use your VA loan, if you pay the loan off later, it refreshes. So VA loans generally have a cap of like $500,000 right now, depending on where you live. If you pay it all back, then you get all your eligibility back again. So I did my VA loan for my first house. The next house we buy, we'll probably use the VA loan again. There is a funding fee that goes into there. So unless there's a 10% disability, then you have to pay like a 2.2% down the first time, like 3% down every other time after that. Unless you have as like a funding fee, not a down payment, just like an extra expense. But that's only if you don't have a disability. So when you work with a mortgage company, not the pre-approval time, just get a regular pre-approval. But when you actually look at financing, I would have them compare anything that's available to you, right? Yeah, what would a VA loan look like? What would this look like? What would this look like? Just spend 5 minutes and run me the numbers. And then you can make a more educated decision on which loan product you think is most appropriate for you and how you want to go about that. Cool. Good question.
Thanks.
What else you got? Anything from the gallery? Anything from the hidden people? Kim, you got any questions?
I do not. Thank you, though.
All right. All right. Well, if nobody's got any more questions, we're going to meet again in 2 weeks. So that is October 26th. So we'll meet again October 26th for a TBD discussion. Look for a poll to be posted in Mighty Networks either tonight or tomorrow morning about what that topic's going to be. Cool. Everybody have a great night.
Thank you.
Bye.
Thank you.
Bye.